Asset management is an industry undergoing rapid transformation. In your view, who wins in that environment? Who loses?
Erik, we have never seen such a disparity between winners and losers in the asset management business. I mean, for most of my career anyway, a rising tide floated most all boats. And unless you did something sort of truly bad in terms of your investment performance, you did fine. That world is over. The combination of fee pressure, a much higher focus on performance, and on this movement toward consolidation of managers by the large pension funds, we're seeing just a few business models winning and most losing. We see the large passive players doing well. We see the larger boutique managers, largely alternatives, doing well, private equity firms, some of the private credit firms. And then there's a few firms that are global in nature who have very strong investment performance across both active and public and private asset classes that are doing very well. And the vast majority of firms, if you're just doing public equities, you're just doing fixed income, you're struggling. You're in outflows, and we don't see that really changing anytime soon.
What percentage of the asset management industry is that?
In terms of number of firms, it's probably about 80% of them are struggling. In terms of assets, obviously, the winners have a disproportionate of them, and it's much more closer to 50-50.
Now, is that 80% going away? Or do they survive in consolidation? What's the future?
That's the great debate. People say, if this was a truly kind of industrial industry, wouldn't you expect consolidation and capacity to come out? But this logic has been true for a number of years, and it never really happens. And the reason it doesn't happen is that the asset management industry is a profession and not a business. It is driven by a fiduciary duty to clients, not by doing absolutely the thing to maximize shareholder value. So clients don't necessarily want these businesses to be consolidated. They may be happy with their investments the way they are, and they certainly think that most M&A creates a lot of cultural issues, which actually hurts their returns. So they're generally not in favor of this, which is why it doesn't happen as much as you would think it would.
Does sound like the 80% is kind of going away.
Going away, but how? And I think our view is that they will become, I've used the term kind of zombie firms, where they continue to exist. They are in outflows. Their margins are not as good as they were, but they still pay the bills. But they don't ever really go out of existence. And therefore, capacity doesn't really come out of the industry, which is also one reason why you see a lot of fee pressure.
Tell me about the fee pressure. Is it as intense as ever?
So the fee pressure, I think, is sometimes mischaracterized as a broad industry trend, when actually it's much more targeted than that. There is no question that public equities in the United States have seen a lot of pressure on fees. Part of that's been the move to passive, but part of it has also been people looking for the best vehicles, whether it's the right share class or ETFs that are just cheaper for them to wrap the strategies. But if you look more broadly at asset management and you say, do we see it in private equity? Do we see it in real estate? Do we see it in private credit? The answer is no. And in some ways, PGIM is a very good example of that. So we certainly see fee pressure. But over the last 5 years, our average fee yield has been 22 basis points completely consistent, because we've been growing higher yielding strategies at the same time when we've had some fee pressure on the retail side. So we're a good example of how it's certainly true, but it is not a dominant theme across the industry.